All right, it is 11:30. Let's go ahead and get started with today's webinar. Welcome to today's webinar, Your Cash Flow Statement, brought to you by Royal Wealth Management. This is the third in a series of webinars that you can attend monthly on the second Tuesday of every month, starting at 11:30 a.m., lasting between 30 and 45 minutes. At Royal Wealth Management, we understand the significance of supporting your financial goals and fostering a culture of financial wellness. These monthly webinars are part of our commitment to helping you pursue financial well-being by equipping you with the tools and knowledge necessary to make informed financial decisions. In today's webinar, we're going to discuss why your cash flow is an integral part of your sound assets that can be put to work, helping you pursue your financial goals. So before we begin, let me introduce myself. My name is Darren Royal. I'm the president and owner of Royal Wealth Management. My firm's been helping clients pursue their financial goals for over 20 years now. Royal Wealth Management was founded to assist clients in every aspect of their financial lives, and we strive to help create financial stability and security for each one of our clients. We want to provide people with the tools that can help them make informed decisions. So we offer informational material on a wide range of topics because we understand that individuals have a diverse financial needs. So keep in mind that the information in this material is not intended as tax or legal advice. It may not be used for the purpose of avoiding any federal tax penalties. And please consult a professional for specific information regarding your individual situation. With that being said, let's get started. So, money. It's a simple linen and cotton paper, right? It doesn't weigh much or keep much space, but printed money is a major part of our lives. In 2020, the Bureau of Engraving and Printing printed roughly just over 5 billion pieces of paper currency with a face value of 146. How much of that money is going into your savings and investments? Money is one of the things we think about every day, and often many times a day. But while we may think about it, talk about it, and even worry about it, we sometimes fail to take the time to manage our cash effectively. Every successful investor knows that management of cash assets is a key to a sound strategy. To begin with, you'll want to understand how time may influence your ability to reach your goals. And next, you're going to also want to take a look at your financial profile and examine your credit standing, your cash holdings, and whether it is time to rebalance your cash portfolio. Once you understand the role time plays in your long-term investment outlook, you can be better prepared to make wise decisions when it comes to cash management. Having a good handle on how your credit score can affect your purchasing power could also help. There can be a correlation between your credit score and the rates you may be charged at any type of installment debt. And a higher credit score has the potential to add up to real savings over time. So let's take a look at how it might help you. In this example, let's consider a $400,000 loan with a 30-year fixed rate mortgage. So an individual with a credit score of 620 may qualify for a mortgage interest rate of 5.83%. At that rate, the mortgage may carry a monthly payment of $2,000. Now let's see what may happen if the person's credit score is above 760. With that credit score, the individual could qualify for a 30-year fixed rate mortgage with an interest rate of 4.24%. The monthly payment would be that's a difference of nearly $388 per month, or over $4,600 a year. Now, over the life of the mortgage, that difference adds up to nearly $140,000, more than a third of the cost of the home, just because of a credit score. One of the goals of a sound financial strategy is to find the appropriate mix of investments. At the bottom of our illustration are cash alternatives, which have low risk but also offer the lowest potential return. As you move higher up the illustration, each section represents the opportunity for higher potential return, but also may carry higher risks. The reason why cash alternatives are at the foundation of a well-balanced portfolio is that cash alternatives allow you to meet short-term and unpredictable expenses. So having cash and cash alternatives also may allow you to manage other investments rather than selling at what could be an inopportune time. Keep in mind that allocating your assets among different investments is an approach to help manage investment risk. It does not eliminate the risk of loss if a security price declines or market risk. The FDIC insures bank accounts up to $250,000 per depositor, per institution in principal and interest. However, other cash alternatives such as money market funds are not insured or guaranteed by the FDIC or any other government agency. Money market funds seek to preserve the value of your investment at $1 a share. However, it is possible to lose money by investing in a money market fund or other cash alternative. One effect of the financial crisis of 2008-2009 was Americans broke a long-term trend of low personal savings and increased the amount of money they saved. As the chart illustrates, total household debt rose continuously from 2006 until it hit a high in 2008. During that time of financial turmoil, the personal savings rate, as measured by the Federal Reserve, started to climb steadily. And in 2012, personal savings reached over 9% of disposable household income. Later, as the economic recovery gained some momentum, personal savings once again slowed while household debt climbed to new levels. A closer look at the chart shows that through America's personal savings rate climbed higher during the recession, the rate of savings growth in the U.S. has slowed as the economic environment has improved. Meanwhile, debt has steadily risen. This pattern of spending during good times and saving during bad times is understandable, but a better approach is a steady, consistent program of savings. For that portion of the portfolio that must be liquid, most investors consider one or more of four places. Each has its drawbacks and advantages. There's traditional bank savings accounts, like savings and checkings. They are both guaranteed up to a certain limits by the FDIC. However, traditional bank account returns are modest at best. The certificates of deposits, on the other hand, are time deposits offered by banks, thrift institutions, and credit unions. They may offer a slightly higher return than the traditional bank savings account, but they also may require a higher amount of deposit. If you sell before a CD reaches maturity, you may also be subject to penalties. Then there's bank savings accounts and CDs that are FDIC insured up to $250,000 per deposit or per institution and generally provide a fixed return, whereas the value of money market funds can fluctuate. Money market funds, as I mentioned, are investments that seek to preserve the value of your investment at $1 a share. Money held in money market funds is not insured or guaranteed by FDIC or any other government agency for that matter. It's possible to lose money in investing in these. Treasury bills are actually debt-based instruments, and investors lend money to the U.S. government and are paid a specific rate of return. Treasury bills are backed by the full faith and credit of the federal government as to the timely payment of principal and interest. If a Treasury bill is sold prior to maturity, there is opportunity for the capital loss or gain, depending on the interest rate environment. Now, cash alternatives offer low risk, low potential returns. Each of these investments may be vulnerable to taxes and inflation. It works like this. Let's assume you invested $10,000 in a CD earning 1%. After 1 year, your account would be worth $10,100. After taxes on the interest are paid, the account would be worth $10,000. When you need to account for the effects of inflation, assuming a 3% rate of inflation, the account value would actually be equivalent of $9,000. So if you aren't careful, you can actually lose purchasing power with your low risk, low potential return investments. Interestingly, many investors move in and out of cash alternatives depending on volatility of the markets. This chart shows the pattern that unfolded in the wake of a recession that began in 2008. The yellow line on this chart shows the performance of the Standard & Poor's 500 stock index, generally regarded as representative of the U.S. stock market. Beginning in mid-2008, the market experienced a steep drop that lasted right through March of 2009. The market then began a slow and steady advance. The green line shows the total funds invested in money market and mutual funds, one of the cash alternatives we were talking about. As you can see, it rises in a near mirror image of the stock market line. That means as the market crashed, investors moved their capital out of stocks and into money market funds. Then, when the market began to recover, they slowly began moving back. Though this response to financial instability is understandable, it is driven by emotion and may not benefit the investor. A better approach to consider is to have adequate savings on hand at all times and to consider investing the surplus in a balanced portfolio for the long term. At any stage in life, it's wise to reserve enough cash on hand to cover your expenses in three areas. First, you should be able to replace your income for a short period of time in the event of a job loss or a loss of investment income. A good rule of thumb is to have enough on hand to replace your income for 3 to 6 months, or consider setting aside a fixed dollar amount based on your individual situation. Second, you should make allowance for emergencies that may occur, such as catastrophic illness or an accident. And third, you should have some cash on hand for upcoming large expenses, such as a wedding or extended vacation you may plan. It'd be nice if we could fill out a simple form and determine how much in savings is right for everyone. But each situation is unique, and you may have special considerations that will affect your savings portfolio. After you've made a list of outgoing expenditures and then narrowed that list down to those that are absolutely necessary, you will have a starting figure for your savings. Then ask yourself the following question. First, how many sources of income does our family have? If you are a two-income family, the chances that both of you will lose your source of income is less than if you are a one-income household. Next, are you paying off some debt? If so, you may want to keep a lower amount of your cash in emergencies. For example, a dependent parent or child with health concerns may require additional emergency reserves. The liquidity of your investments can affect your savings portfolio. If you have investments that are easily accessible, you may need less in your savings portfolio. If, on the other hand, most of all your other investments have little or no liquidity, your savings portfolio should be adequate to meet your needs, perhaps for a longer period of time. Finally, examine your own comfort level. For some people, that may require a larger dollar amount than for others. Finally, you should consider the cost of traditional savings. For example, some investors who bought 3-year Treasury bills in 2009 when they were yielding only 0.15% may have actually lost money to inflation. This graph shows the historically low rate of return offered by 3-year Treasuries between 2009 and 2012. Since then, they've rebounded. These low rates of return have caused some investors to re-examine cash alternatives and allocate more cash to higher risk investments with higher potential rate of return. The market value of a bond will fluctuate with changes in interest rates. As rates rise, the value of existing bonds typically falls. If an investor sells a bond before maturity, it may be worth more or less than the initial purchase price. By holding a bond to maturity, investors will receive that interest payments due, plus their original principal, barring default by the issuer. Investments seeking to achieve higher yield also involve a higher degree of risk. It's important not to confuse savings with investments. Many people do this without realizing. Savings should be cash and cash alternatives, which are considered safe, liquid, and easily accessible for emergencies. An investor's portfolio should pursue the best possible return with the lowest possible risks. In this illustration, an investor may have too large of a portion of his assets in cash alternatives. The money is in low risk, low return investments. However, that money is not safe from taxes and inflation. These factors cause some investors to reconsider their mix of investments. That is, some investors may want to pursue investments that have higher risk with the potential for higher return. One of these options may include fixed interest investment. A fixed interest investment may have penalties of early withdrawals and other restrictions, so it's important to have adequate savings on the foundation level. Without a definite plan, it's easy to let emotion cause us to jump to higher risk and higher potential return. In this example, Ron and Susan have $150,000 in CDs. As these reach maturity, they decide to take $100,000 and divide it between 3 stocks, looking for higher potential returns, but perhaps not understanding the higher risks involved with stock-related investments. Ron and Susan need to understand that past performance does not guarantee future results. Cash alternatives, fixed interest, bonds, and stocks can be important parts of a balanced portfolio. But before you jump, consider your individual situation and understand the risks. In another example, Bob and Lydia have $150,000 in savings invested in a CD. When the CD matures, they sit down with an investment professional and calculate their savings needs. They find that a savings portfolio of $75,000 is adequate to meet their income needs in case of an emergency. After some consultation, they decide to place the remaining $75,000 in a fixed interest investment. Take control of your money is a lifelong process. Here are some questions that arise at different stages in life. Anthony and Selena, two-income couple with school-age children ask, how much money do we need in savings to safeguard our current lifestyle? Dave and Christine, a couple nearing retirement, want to know, is there a better place than a savings account to keep our reserve? What should we do when our CD matures? Rebecca's a single parent and a small business owner. She asks, how much investment liquidity do I need in order to protect my interest? And Isaac likes to do research online. He asks, in an environment of low interest rates, should I be taking more risk? The answers to these and other concerns will vary with each individual situation and can all be addressed in a review. There are a number of strategies you can use to find appropriate mix of cash alternatives. And that's where Royal Wealth Management comes in. We specialize in helping people just like you access their investing strategies as they work to pursue their goals. We invite you to take advantage of our complimentary 30-minute consultation. You can book time directly with me by using the middle QR code and choose phone appointment. To stay up to date with our additional educational opportunities, be sure to link to us on LinkedIn, and don't forget to check out our website. There you can learn more about Royal Wealth Management and sign up for our monthly newsletter. If you had any specific questions that you'd like answered, you can email them to Darren, D-A-R-R-E-N, .royal, R-O-Y-A-L, @LPL.com, and we will get back to you as soon as possible. You may also give us a call at 72. That's the end of our presentation today. I'd like to thank you for attending, and have a good day.